DSCR loans, my second favorite way to finance real estate deals and why they should be one of yours as well. By the way, this stands for debt service coverage ratio. Maybe I'll put some text on screen. I don't know. And in this video, we're going to talk about what they are, why they're important to you, and why they're probably one of your best options for financing real estate investor deals. Greetings, my name is Skylar. I'm a Louisville, Kentucky real estate investor. I've been doing it for a couple of years now. I specifically do buy and hold real estate in Louisville, Kentucky. And I'm also embedded with a lot of the other investors here in town and the contractors. So I've come to pass on what I know to you. By the way, this is a legal disclaimer. This is for entertainment purposes only, not financial advice. Seek a professional. You know the deal. Okay, first and foremost, the DSCR loan is debt service coverage ratio loan, is the income that you make on the property divided by the mortgage payment that you pay on it every single month. If that number is above 1, then the property is paying for itself. A lot of banks care about, not always, because some banks obviously defer, but it's most lenders care about the DSCR loan being at least a 1, 1.2, something like that. So for some easy numbers, let's say you make $1,000 on the rental income on a property a month, and the mortgage expense is about $700. You're going to look at a DSCR loan of about 1.2. And this is why investors love, like me, investors love this kind of loan because, as I mentioned in the previous video, it is no income verified. So they're not going to look at W-2s. They're not going to look at, your tax returns. They're not going to do that. What they're going to do is they're going to say, hey, does the performance of the asset perform well or not? And then they give a loan based on that. And a lot of those loans can look pretty similar to your conventional loan. So you might talk to a financial institution that says, hey, I'm going to give you 25, 30 years at 7%. This is 2026 numbers, 7%. And, you'll just pay that like a normal mortgage. And it's also fixed. But there is a trade-off when you do that. So the trade-off being, because the loan type is considered a little bit riskier than your conventional loan, it's not uncommon to see the DSCR loan interest rate run a little bit higher than your conventional loan. So for example, let's say a normal conventional loan in the market's going to give you 6%, you might see a DSCR loan of like 7 to 8%. So a little bit higher. And obviously, what does that mean? Well, it means that if you're really tight on your margins in terms of your cash flow on the property and your percentage is going to make or break the deal, then just keep that in mind. One more thing I should mention, and this actually happened to me in real life, and it stalled me for, a year on refinancing the property and then finding more real estate properties, because there was something that I didn't know that I think is very important for you to know, which is a lot of these lenders, not only do a lot of these lenders have a lot of specific types of terms, but you could see random terms like, hey, I'm not going to give you a DSCR loan or a loan under 75K, for example. 75K is our minimum. We're not going below that. And then the other thing they might say is, hey, I'm not going to give you a loan if the property is under 600 square feet. That happened to me. I had a 30 to 60 square foot house. The home, when I purchased it, was about 70, and obviously I already put 20% in, so I owed, 70 minus 14, 56 on the property. And it took me forever to find anybody who would work with me. I had to talk to 15 to 20 financial institutions before I could find somebody who would actually service us a loan because the house was very specific. Granted, the house is also really specific in that it was small, and you probably won't see a house like that too commonly, but that did happen to us, so just keep that in mind. By the way, you can use a DSCR loan for an Airbnb, but they're going to look at the projected earnings on the property to other Airbnbs in that area. I mean, it's pretty much the same thing. They just do it slightly different. They have a different market calculator that they use. But yes, you can use it for them. Oh yeah, I also forgot to mention, and I've mentioned this in the other videos, but for this loan, you should put up front or at least own 20 to 25% equity in the property. So while a conventional loan may let you get away with 80, in my experience, a lot of DSCR lenders, and again, these are not banks, right? They're financial institutions. There is a difference. Go look it up. They're not going to give you a 20-80 ratio of, ownership to the bank owning it. They're going to do more of a 25 to 75% split. But there is a benefit to that. And I've spoken to lenders before. They say, hey, if you don't maximize the 25 to 75 split, and let's say you actually own, I don't know, 30, 35% of the house, you can actually get more favorable terms for that loan. So think about that as well when you're trying to refinance, or if you're looking at a property and you got it way under market, maybe don't pull out the most amount of equity you can, because again, you might get better terms, and pulling out some equity might be better than pulling out all of it. So to recap, the DSCR loan is based on the performance of the asset, while a conventional loan is actually based on your performance and how much income you make. The other thing I forgot to mention is a DSCR loan is a great option. Even though the interest rate's a little higher, when you surpass 10 homes, or if you have at least 10 mortgages that are all conventional loans, you have to think of other options. DSCR loan is probably my second favorite option. Great. So now that you know all of that stuff, what do we do now? How do we come up with the money? Am I going to come up with 20% to buy a house every time? Because if I try to do that, or if you try to do that, you're going to run out of money pretty quick. I don't care how wealthy you are. Most of us are probably going to run out of money. So what do we do? We're going to talk about private money lending in the next video, and how we can use friends, family, or even local companies, private money lenders, to afford the down payment for a house. So stay tuned for that. Please follow me if you would like to hear more. Like the video, it's free and it helps me a lot. Subscribe, and I'll see you in the next one.